Our next three slides are all related. First, we're going to discuss accounting principles, then assumptions, then constraints. First are the basic accounting principles. First, we have the measurement or cost principle. This means that accounting information is based on actual cost, not what something currently costs in the marketplace. For instance, if we bought a piece of equipment, we're going to put it on our books for what it cost us. We're not getting it reappraised every year to see what it's worth because that would be too objective. The only time that we can get something appraised basically or change the value to what it's currently going for is when we're dealing with stock, and we don't get to that until accounting 2. So that's something you do not have to worry about right now. Next, we have the revenue recognition principle. This recognizes revenue when it is earned, not when received in cash necessarily. For instance, this is how we're going to do all of our journal entries. If we make a sale and someone pays us later, we're still going to recognize the sale when we performed the service or gave them the product. If we got paid early in advance for something, we're not going to recognize it as revenue until we have completed our part, which is providing the service. So, revenue recognition means that we're going to record something as revenue when we have completed the service or provided the product to the customer, not necessarily when cash is paid. Next, we have the expense recognition or matching principle. A company must record its expenses incurred to generate the revenue reported in the same time period. This means if I look at a monthly statement that shows all the revenue I made that month, I'm also going to see all the expenses related to me earning that revenue. For example, all the salaries of all my employees who had to work for me. I needed to pay them in order for them to help generate these sales. Lastly, we have the full disclosure principle. A company is required to report the details behind their financial statements that would impact users' decisions. You cannot withhold something on your financials if it's important. If it would make the difference between having someone invest in you or not, then it's important enough for it to be disclosed on your financial statements. This next slide is on assumptions. Everything on here are things that we're assuming. First, we have the going concern assumption. This is the assumption that the business will continue operating instead of being closed or sold. If an auditor didn't think that a company would be in business this time next year, they would have to disclose it on their annual financial report. Unless disclosed, we're going to assume that this is a viable business. Next, we have the business entity assumption. A business is accounted for separately from other business entities, including its owner. If I'm looking at the financial statements for company A, it's only on company A, not B, C, and D all added together. Next, we have the time period assumption. This presumes that the life of a company can be divided into time periods, such as months and years. Lastly, we have the monetary unit assumption, where transactions and events are expressed in monetary or money units. The final slide of this topic is on constraints. These are things that hold companies back from having perfect financial reporting. First, we have the cost benefit constraint. Only information with benefits of disclosure greater than their cost need to be disclosed. I always say that in order to have financial statements be 100% perfect, you need to check 100% of the business, which is usually impossible. Imagine if we had to check every single piece of inventory Amazon had to make sure that it was all there and it wasn't damaged or broken. They would have to close the business down for months probably and hire thousands of people to check every single item. The cost isn't worth it. If a few slip through the crack, that's okay. It's worth it compared to how much they would spend to have every piece of item checked. The other constraint is materiality. Only information that would influence the decisions of a reasonable person need to be disclosed. If you have a multi-billion-dollar company and one account is off a few $1,000s, that is not material enough. That would be considered immaterial. It's not worth investigating compared to how much the business is as a whole. This is something you learn a lot about in an auditing course.